Getting back to the top thing this morning, concerns in the banking sector, they continue to weigh on global sentiment. Deutsche Bank shares plunging right now. And this also all comes as Treasury Secretary Janet Yellen tried to calm investor fears around the economy. Let's bring in Wall Street Journal reporter Ben Eisen for the latest here. And Ben, there's been a flurry of news, even new news this morning that's come out, especially around Deutsche Bank, as we know that some of the concerns continuing there, default insurance, that's spiking. And so with all of this continued, where does this really set us up for the reassurance or the attempted reassurance of confidence that we've seen among regulators and lawmakers into the banking sector?
Yeah, you've really seen panic kind of ebb and flow over the last couple of weeks as we've seen this banking sector turmoil play out. And now it's picking back up again. And what we're seeing today with Deutsche Bank is there's not that much of a catalyst, it appears, for this stock to drop, but investors are really kind of picking up the weak links in the financial system. And, we've seen Deutsche Bank have troubles for many years now. And now investors are sort of turning their eyes to this bank. If you think back to Credit Suisse and everything that happened with it over the last week, it didn't take much to kind of get the stock to start dropping and kind of leading to everything that played out over the last week. So now Deutsche Bank is sort of investors' focus of the moment.
Ben, great to see you here. Just wondering, you've been writing about this for the Journal, all the different facilities and the potential rescue missions that the banks have been organizing, that the Feds have been organizing for the problem here. And in one of your reports, you liken this and you throw back to 1907, and that's when John Pierpont Morgan, the original J.P. Morgan, organized a rescue for the banking system around the panic of 1907. And we've seen banks come together before. I could go back to 1998, long-term capital management that was orchestrated by the New York Fed. And then we have Jamie Dimon, which you're writing about, or which you have written about, orchestrating a $30 billion deposit kind of bailout for these banks. So clearly there's something big happening here, but we haven't really seen huge shoes dropping, at least in the U.S. Just wondering what your sense is, how this compares historically to some other bouts of panics that we've seen in the U.S.
Sure. Well, you've really seen in the U.S. there have been huge coordinated efforts to try to stop this, what we've seen start here in the U.S. from becoming, an even bigger panic. Right. You did see some of the big banks step in with First Republic Bank, which is another one under pressure, and try to kind of stop that bank from falling further and sort of draw a line in the sand and say, hey, we're not going to let this bank fail. You've also seen the Treasury Department has, as you've said, put some of these facilities in place. And you are seeing banks in the U.S. Starting to use these. The latest data that came out yesterday showed that more banks are using the new facility that the Treasury Department has put in place, that the federal regulators have put in place to basically borrow against the bond holdings that they have that have lost a lot of money. So in the U.S., you are sort of seeing signs that some of this stuff may be kind of plateauing. It's obviously very early to say what will happen. But as they say, when the U.S. sneezes, Europe catches a cold, and that's when you see these sort of worries jump across the Atlantic. Perhaps some of these issues can kind of take on a life of their own.
The credit default swaps at Deutsche Bank are far less than that of Credit Suisse, and we had watched and seen what played out with Credit Suisse and the eventual fire sale there. But even as we think about how banks got so caught so flat-footed, how did that happen from your perspective?
Sure. Yeah, I think it's a good point. And just to know, credit default swaps can be very illiquid. It's not necessarily the only thing to watch when you're deciding. I mean, when you're trying to figure out what's going to happen to a bank. But that said, this all sort of started with Silicon Valley Bank, which sort of did start with a big drop in its stock. They decided that they were going to sell some shares and that they were going to take a loss on part of their bond portfolio on March 8th. And then on March 9th, the stock dropped 60%. And there was just so much panic that was created around that bank that it actually did start to cause a run on the bank. So, sort of what we've seen over the last couple of weeks is the stock itself may not necessarily be a problem, especially for a U.S. regional bank, unless you start to see deposits flow out in tandem with that. And while deposits have moved around a lot over the past couple of weeks, the question of like, is there going to be a run on another bank is not necessarily tied to what happens with the stock or with the actual trading of the securities. So, it's hard to say that what necessarily will happen with any other bank.
And Ben, we have time for one more. I want to get to the heart of the problem here. And for that, let's go to the Wi-Fi Interactive. You take a look at money markets, mutual funds. They've been attracting funds at an amazing clip. Here's Jim Bianco, just tweeted this morning. Assets increased $117 billion last week. That's after $121 billion the week before. And here's a graph. This shows the incredible surge in assets into money market mutual funds since the Fed began aggressively raising rates. And now we got these funds that are offering 4.75% or thereabouts, the low end of the Fed's target range here. And meanwhile, savings accounts are paying 0.5%, sometimes 1% on the high side there. I'm just wondering, in the conversations you're having with some of your sources here, do people worry about this problem that there's a fundamental mismatch between the amount that depositors are being paid and that's why we're seeing this huge capital outflow from banks in the first place?
Absolutely. I think, even going back a couple of months, there were a lot of questions about why have deposits not repriced in the way they have, and why haven't depositors been taking their money out of these savings accounts, these checking accounts that yield so little, and putting them into higher yielding accounts. And, you started to see that happen. It hasn't happened sort of at the pace that maybe some people expected. But now that we sort of have this big, broad conversation happening nationally and globally around, what's happening with deposits, I think people probably do have a better sense of what they're earning on their deposits in a bank account versus what they're earning in a money market fund or a higher yielding account. So, it is possible that you start to see, everything that's happening be a bit of a wake up call for people to kind of come in and understand, yes, I can earn more on my money right now.
Yes, they can. I think people are exploring that option as we speak. Thank you for that, Wall Street Journal reporter Ben Eisen.